Welcome back. And in our business news, Dubai's Jumeirah Group has confirmed that it is to open its first hotel in India in 2017. According to a local paper, the group has signed an agreement to open a 470-room luxury hotel in the lower Parel district of Mumbai in 2017. Gerard Lawless, President and Group CEO of Jumeirah Group, was quoted as saying that the demand for five-star hotels in the Indian market has been robust and that the Mumbai property will be the first of a series of hotels that Jumeirah is planning as a part of the expansion into the Indian market. In July, the UAE and India signed an agreement to double the flow of tourists between the two countries. A new report from the World Bank has revealed that governments in both oil and non-oil-rich countries will have a need to increase tax revenues in order to balance their budgets and at the same time still provide an attractive business environment for investors. Audit and tax advisory firm KPMG is currently hosting the 2012 MESA Tax Conference in Dubai to discuss the impact and challenges on the Middle Eastern region, from tax transparency to new technologies to how tax fits into economic issues. Over 150 people from 30 different countries are attending the conference today, with a key point of discussion on how taxes are considered for both inbound and outbound investments and how multinationals comply with the rules. Greg Weeb, the global head of tax for KPMG, shed some light on the UAE tax system in particular and what could potentially be implemented in the future to keep pace with the ever-changing global economic landscape. He added that the region has been in many ways immune from fiscal shocks from other parts of the world.
Well, the UAE is fortunate in that it doesn't have a lot of tax at this point. I think it's going to run a 10% surplus this year because of the revenues it receives from its oil exports. It is a very low tax regime. It receives about 2% of its revenues from customs duties that it imposes. As it looks to expand its economy, get involved with more free trade agreements with other nations, those customs duties are going to have to decline. That's typically a requirement as you enter into agreements with other countries. So look for custom duties as a source of revenue for the government to decline, and that'll have to be replaced likely with something, perhaps over the medium term, with a VAT. If the government wants to look for ways to expand its revenue sources other than just oil and kind of diversify its risk, it can look at taxes like VAT, like personal income tax, and like corporate income tax. Obviously, these are political issues. Government needs to decide what works best for its society, and so it's very difficult to generalize.
The Emirates Securities and Commodities Authority has announced that the financial markets in the UAE will be closed on Sunday the 2nd and Monday the 3rd of December in order to mark the 41st UAE National Day. Markets will resume trading on Tuesday morning, December the 4th. So with that, let's now take a look at the stock indices across the GCC. And looking to other business news, risk sentiments closed the week on a positive note, with the euro posting another week of gains against the US dollar. Gold also moved higher in a shortened trading week, with the European Commission, the IMF and the ECB set to meet this evening to thrash out a plan for Greece. We earlier asked Gaurav Kashyap, the head of the DGCS desk at Al-Pari Middle East, to find out what possible outcomes could influence risk sentiments and the performance of the dollar in the week ahead.
To kickstart this week, risk sentiments will be driven by the results and the developments emerging from the meetings taking place between the European Commission, the International Monetary Fund, and the European Central Bank as they attempt to thrash out a plan for Greece. Remember, 44 billion euros in bailout money is on the line for Greece. We did have some developments from last week's meetings where basically Germany and the European Central Bank were very reluctant to accept haircuts on any existing Greece holdings that they had. And of course, the IMF also was very reluctant to increase the timetable, the 2020 timetable, where Greece was supposed to reel in their debt to GDP ratio. So once again, we're going to continue to watch for developments that will be coming throughout Monday's trading session. We don't expect anyone to walk off from the deal, so any types of positive announcements will see risk sentiments take the euro higher against the US dollar, and we'll also see equity markets increase, resulting on how those developments come out. Looking at the rest of the week, the focus will continue to be on the global growth story. Of course, the headline number will be Friday's U.S. third quarter GDP reading. Now, the July to September period from the U.S. was originally expected to show growth at 2%. The expectations are now at 2.8% on the back of very, very strong exports. On Tuesday, we have the headline UK GDP reading number expected to come at 1% quarter on quarter and 0.0% year on year.